Alright, so now it's time to get to the second part that I wanted to talk about. Now this is on an even wider scale. We're now going out of the US and we're talking about Middle Eastern nations, South American nations, whatever. Where is the activity going on on a global scale? So we can first see what's happening to production. Iran, for example, as a result of the sanctions from the US, Iran's production has dropped rapidly. They used to have about 3.5 million barrels per day, and now it's approximately 1.5 million barrels per day. Now, here's the problem though. That doesn't account for black market oil sold on the market. And with these sanctions, it's very possible. In fact, it's extremely likely. And according to satellite data provided by sources for analysis like tankertrackers.com, you can see many of the initial ships traveling from Iran and different ports located around Iran to nations that shouldn't be doing trade with Iran, or at least those ships and tankers that have been sanctioned off and shouldn't actually be departing. So there's a lot of cheeky tactics going on, and that has fueled the thoughts in many hedge fund traders' minds of actually, are we being oversupplied? Here's the problem though. You're having a drop in production from the ones who want the oil prices down. When America has increased their production, by the looks of it, there will only be a certain point where their industry could even risk a low oil price based recession, because companies like ExxonMobil, they need to make money from good oil prices. Let's go out of the US and go to the UK. In the UK, most North Sea oilers need about $50 break even. If you see anything below $50, you got to start running for the hills as an investor. And what can the companies do? Stop production and keep paying off their fixed costs, losing money, accumulating debt? That's what happened in 2016 when Brent touched $27. In fact, companies racked up so much debt, most of them are now just gradually paying it off. They've strategic refinancing plans, restructurings. A lot of companies like Excite Energy, and I can't remember the name of the other one, but the two CEOs got arrested for money laundering as well. I don't think I'll be able to remember. But companies like that who weren't able to cope with such low oil prices and just went bust. In fact, many investors, I've met a few people that have lost a lot of money on those companies in particular. But that's why sometimes you need an oil price that's like a compromise. You can't have it as high as the 80s because you risk inflationary risks, but you can't have it so low because you risk busting your energy industry. So that's quite interesting. Now, looking at other countries, Libya, there's a lot of tensions there, obviously geopolitical tensions. There's not really a government. It's been split into factions. It has been for a while, since the overthrowing of Muammar Gaddafi. And production there is just dripping away, low levels. It's difficult for people to do trade with them because of obviously risks of getting paid and all of that. Credit default risks, once again, it's quite an interesting one. And speaking of credit default, right, we can go on to now talk about Venezuela. Venezuela's production, many analysts are actually expecting will go towards zero, because their domestic break-even, basically their break-even to cover their domestic spending per barrel of oil, well, measured in a price per barrel of oil, is $300. Now, we're not likely seeing $300 anytime soon. Who knows, maybe long ahead in the future if we have a shortage of oil, then maybe so. But $300, a lot of that factors in corruption. Where does the money really go? In fact, I read a metric the other day that 8.3 kilograms is the average amount of weight loss per citizen in Venezuela. It's crazy. And it's almost as if you think, oh, well, maybe if they didn't have resources, then that would explain it. But actually, Venezuela has the largest prospective reserves of oil in the world. That's a crazy fact. We've got to realize that actually economic mismanagement, governmental mismanagement, all of that leads to more problems. Now, what does this mean for oil as a whole, or at least the oil market? Well, if you have production dripping away from Libya and you have production dripping away from Venezuela, but you also have production hikes from the US, but you've now had production cuts from Saudi Arabia after production hikes. I remember there was an OPEC meeting recently, and this OPEC meeting consisted of obviously major oil producing, the Organization of Petroleum Exporting Countries. That's what OPEC stands for. So like Saudi Arabia, Russia, etc. Saudi Arabia said they were going to cut. Russia had to cut. Russia didn't cut that much. They did 300 to 500,000 barrels per day, and the entire organization as a whole did 1.2 million approximately. Oil prices actually rose despite the expectations being 1.4 million barrels per day, because on the first day of negotiations, no deal was made. Oil prices were down about 4 or 5%. And then in the second day, it looked like no deal was going to be made. Russia wasn't even going to cut 300,000 to 500,000 barrels per day, when they can still be actually the most beneficial party. Russia's economy drives off its sales of oil and natural resources and whatever. But Russia has a tendency to create a lot of tension. And Russia said that they're happy with $60 oil price. Saudi Arabia said they're happy with the range of 60 to 8 or 70 to 80, something like that. Now the oil prices have dropped, 30% in a few months? That's crazy. The markets are panicking, right? But what happens to producers that are hedged at higher prices? A lot of companies, I could point out Ophir, Enquist, Tullow, Gulf Keystone Petroleum, Janelle Energy, Premier Oil. Those mid-cap oil producers and exploration companies are hedged from prices that were about $80. Now their hedges are about 69, 72, something like that, for first and second half of 2019. And hedging is basically when you say, all right, the oil prices say $80 at that point. And they say, we're going to forward sell you this much at this price, just for our safety. So at that point, it was 10% below price approximately. And they say, all right, well, if the markets fall or rise, you're going to pay this much for a certain percentage of our production. Say somebody's 30% hedged, then at like $69. They say, you pay us for 30% of our production for the entire year that we estimate. It's a certain amount of million barrels, say 3 million barrels, right? That is at this price, even though it's below the current market price. And then from whatever the market price is, they get that for the rest of their 70% production. So the companies that are hedged are actually saving now, but if prices continue to be lower, they won't benefit in the long run. So that's a scary prospect for mid caps, large caps as well. They're going to take the hit, but they are more diversified and hedged than mid caps, anyways, especially small caps that aren't really hedged that much. Small alternative investment market companies like Nostaterra, oil and gas, that aren't hedged at all, will take hits and likely make losses on their Pine Mills prospect, I think. So there's a lot of things going on. This is an example of what I do to just keep myself updated, because let's be honest, in an era that's transforming at a crazy rate, we can never keep on top if we don't update ourselves. Thanks for listening. If you got this far, I hope you have a nice day. All the best with the competition, or anybody just who wants to learn a bit about the macro data regarding oil. I hope you have a good one. Ryan out.